Hi, great to be with you today. First, we'll spend a minute talking very briefly about McQueen Financial Advisors. We are based in Michigan, but we are a nationwide consulting firm. We have clients in 42 states and offer a whole suite of services for credit unions. Of note here, um, in the lower right-hand corner is primarily what we're going to be talking about today. Is just part of what's in the lower right-hand corner is risk reporting. We have asset liability management clients all over the country, and we are very fortunate that they share with us their opportunities and stress points and exam stress, and we help clients all the time with issues of funding and asset liability management and to answer examiner questions. And this is just part of a much bigger picture and of services that we offer. I want to give one very brief update of our website. We have all sorts of resources on there that go well beyond today's discussion. In the webinar category, we host 10 to 12 webinars every single year, and on topics of asset liability management, investment management, economic updates. We did a special webinar when Silicon Valley Bank collapsed. We did a special one that Monday morning after that. So you can find webinars on our website, and previous webinars are available on our YouTube channel. In addition to that, I am McQueen's writer, and I write at least once a month, sometimes twice a month, on all sorts of industry topics. We call these McQueen Market Insights, and on our website you can find currently 25 of these, and the list is growing every single month. You're free to look around there. We previously made these available only to clients, but recently made them available to the wider audience, and so you're free to look around there and see if there's anything that might interest you. So today's category or today's agenda, excuse me, is on funding and liquidity and deposit strategies. So first we'll go over the importance of this topic. You know, if not done correctly, funding can get very expensive. If we don't have an overall strategy, we might get caught in a bit of stress whereby we're forced to borrow. And we also know that funding is important because so often our funding costs and what we're offering to the public is the front facing thing that members will potentially see from us. One of the biggest challenges here on this topic is that this has not been top of mind for probably 10 years or maybe even a little bit more. If you think back about the period of the most recent, almost probably 10 years, since the last financial crisis, we haven't had a large need for funding. In fact, there have been many times when we would love to have funding run out of the credit union. There's lots of marketing tools that we can deploy. Some are common that will be familiar to everybody on the call, but as a big picture statement, it's good to review them nonetheless. We'll have a strategy discussion as well on deposit pricing, hopefully give some insight onto best practices there. Borrowing options, on the surface oftentimes seem really quite basic, but there are some bells and whistles and some reasons for some caution. And then we'll talk about how this entire discussion relates to liquidity and interest rate risk management, and how we can use the ALM model to measure the effectiveness of our strategy. So let's start out with the importance of funding strategies. So we have ample evidence, as I'm sure most of the people on the call do, that the core local deposits provide us with a very stable source of inexpensive funding. And for the most part, we do not need to raise our deposit rates sharply in response to the Federal Reserve. And we have tons of evidence of that. The Fed funds rate went up 4 full percentage points in 2022, actually a little bit more than that. Short-term treasuries went up in yield more than that. And, most of our clients didn't raise their deposit rates a great deal, certainly not even half that far, right? 2 full percentage points. And many clients didn't make their first change in their non-maturity deposit rates until the Fed had increased rates maybe 400 basis points. But things are changing, right? We all know that, and that's part of the reason we're doing today's presentation. As of December 22, now this is the most recent data that I have available, the industry-wide cost of deposits was 50 basis points. That is about double over the year prior. Now, in this one last bullet point really sort of hammers home the need for strategy, is that if we need to borrow, we're going to find that borrowing rates are upwards of 10 times higher than the cost of local core deposits. We can see ample evidence that there are, lots of institutions, both banks and credit unions, looking to raise deposits. We see it, sort of at every corner and in every market. Funding strategies impact the entire credit union. This gives us a great deal of opportunity for cross sales, and frequent communication with members I think is very important. I happen to be a member of 3 different credit unions. One is small and 2 are much, much larger. And it is rather striking that the largest one communicates with me and my family more than the smaller ones, right? And it's a pretty big place, over $1 billion. But I would say a week does not pass without them sending something to the house. And of course, there's emails and so on. Now that can get very expensive, but they recognize that there is an opportunity to cross-sell when we have regular communication with our members. So having that core deposit account that people use to pay their bills, right? And people have their direct deposit go in there from their paycheck or Social Security. Having that account is very important because it gives us all kinds of opportunities. No other ways where the funding strategies impact the entire credit union is that we need to maintain ample core deposits. This will help us support lending activities and really provide for liquidity needs. And there's probably lots of people who may listen to this who recognize that if we don't have sufficient funds on hand to meet either loan growth or deposit outflow or unexpected events, then it can get very expensive to borrow. And this all goes hand in hand with our deposit strategies. I hear this comment probably more than any other. In my career, I have presented to literally thousands of credit union boards and communities across the country. They want their local credit union. They need their local credit union. They love their local credit union. And our clients, who are credit unions, tell us all the time that they want to remain relevant in their markets. So what does that mean? They at least need to be competitive. They don't want to be the lowest rung on the ladder when it comes to deposit pricing and so on. One key point here about remaining relevant is that when we do a deposit survey, right, we're looking at the local landscape and we find that there's a credit union or a bank down the road and they are offering rates that seem unreasonably high on the deposit side. And we might be inclined to match them. We might get board members or members who are pushing us to match a rate that's down the road. My response to that typically is to go and look at that institution's loan to share ratio. If we are lent out 65 or 70% and we find a credit union down the road that's offering incredibly high deposit rates, you know what we're likely to find? That they are lent out 90 or 95%. So they need those funds more than we do. It's good to know that, but if we find that, it's also good then a reason to examine internally what are they doing that's driving loan demand to the credit union, right? Rather than focus only on our deposits and wanting to match them, let's also look at how they are driving loan demand and what we might do to get more loans, which would of course help us offer higher rates because our income would end up higher. Another example of important funding strategies, we want to achieve sustainable growth. I think this very common and sort of goes without saying. And again, I mentioned that it would be prohibitively expensive to fund loan growth with non-core deposits or borrowed funds. And as an example of this, when I mentioned the McCreen Market Insights earlier, there's one on there on loan pricing and the incremental cost of borrowing. And in that paper, we look at what the margin is and how margin changes if we have to borrow to fund loan growth. And it's not a pretty picture. So I think that goes without saying, but most people, could use a little refresher on that. Almost every credit union you can think of, if they have an investment portfolio at all, they have some unrealized losses on the books, right? And this sometimes forces them to borrow. I would say even credit unions that are 65% lent out, you would think there's no reason for them to have to, rely on expensive borrowing, but it's much more common than you might think. So those are the reasons. Let's look at challenges. And the biggest challenge is very likely we have not needed to attract new deposits in 10 years or more, right? Interest rates were very low. We had all that government stimulus money that came in that flooded us with deposits for the longest period of time. When trillions of dollars came flooding into the financial system, people didn't spend it right away. It remained on deposit. We invested some of it. And we have not needed to think about deposit strategy for a good long time. And for many of us, I'm sure that in order to protect our net worth in ratios, we were hoping that some deposits would begin to run off, but it sure took a long time to do that. So challenge number one is this is new to us. Challenge number two is rising interest rates. I mentioned it a moment ago, but if you look at the Fed funds rate went up over 4 full percentage points. This is only a little over a year's time. The gray line at the bottom is from January of 22, and the blue line at the top is from April of 23. 3-month Treasury rates as a benchmark for yields went up over 5 full percentage points. Now, in our experience, our clients did not need to raise their deposit rates in response to that. I mean, they did raise them, but it wasn't certainly a full 5 percentage points. We also wrote about this topic, how we feel that, many credit unions did not act fast enough on their loan rates to take advantage of much higher investment returns or market rates. And so here's a question to ask yourself. When short-term rates soared by 5 full percentage points, like we see here, what did you do for loan rates? Many people hardly changed their loan rates at all when they really should have been, ramping them up at a very rapid pace. The yield curve is inverted, and there's many definitions of an inverted yield curve. And if you looked at what's been written about this, there's lots written about how you compare short rates to long rates and what it all means. There's a ton of things written on this. The most traditional way to look at an inverted yield curve is to compare the yield, and these are US Treasuries, on benchmark 3-month Treasuries compared to benchmark 10-year Treasuries. And you can see the yield on the short end is 5.12. The yield on the long end is 3.4%. Fully inverted yield curve, if you look at it that way. And every single time since World War II, when this phenomenon has happened, and I believe it's 8 or 9 times, the economy has gone into a recession within 12 to 18 months. Now, some people say that this time is different. Some people say that we're already in a recession, and we're going to look at that in just a minute. I'm not going to make a prediction on whether we're going in a recession or whether we're even in one already, right? That's for others to do, and it's hard to identify it clearly. But this is a challenge for us, right? Because if we are getting pressure to raise deposit rates because short-term rates have gone up so much, we might not be able to make up the difference on higher loan rates simply because loans are longer than deposits generally. So it makes for a very tough environment. When interest rates go up, it's generally favorable for credit union margins, right? But if we have to borrow, Well, that's a different story. And because the yield curve is inverted, it also represents significant challenges. We have increased competition, and that is coming from money market mutual funds. It used to be years ago, and it probably goes back 20 years, when money market mutual funds were all the rage, and everybody was looking at them and comparing those returns to bank and credit union deposits. But they went away for a good long time, and now they are back with a vengeance. So in at least 10 years, probably closer to 15 years, we have not seen money market mutual funds representing a challenge to us, or a yield advantage to us. Right now, the yields are in the range of 4.5%. This is overnight money. It looks and feels a lot like a credit union money market account. Of course, it doesn't have any insurance on it, but a lot of people don't care. These are brokerage company creations, and the brokerage firms will certainly make it very, very easy for people to invest in these things. So that's one of our big competitors there that has been taking money away from our industry. Consumer behaviors are changing a bit. Some of this is, sort of rehash. Obviously, digital banking, mobile apps, and ease of use are just expected now, right? It shouldn't be anything new. If you don't have these kinds of things already, then you're probably a little bit behind. The other big change in consumer behavior is in the prevalence of members moving money out of savings and money market and into term deposits. Over this period of a year, we saw credit union deposits being very stable. That should say December 22 to January of 23. Credit union deposits were very stable, but there was a very meaningful shift out of non-maturity deposits to term deposits. And of course, that is important because term deposits are much more expensive. Basically, I think we might all know this, but if you offer a deposit special with the hope of getting some new money in, you're going to find that your current members move from their savings account to take advantage of that high rate. And there's been a huge shift of that going on in the industry. Another challenge is lower investment values. I think almost every credit union that has an investment portfolio is going to find that they have some unrealized losses, and they're finding themselves maybe in a borrowing position as they wait for the value of investments to, come back around, so that they can either wait till they mature or sell them at least no loss or a premium. We have found many, many credit unions that have even a moderately high loan to share ratio that are in a borrowing position. I just spoke to one before this presentation. They were less than 70% lent out, had $3 million in cash, and were borrowing $8 million, right? Why? Because the investment portfolio was underwater and they couldn't sell anything to generate the liquidity that they needed. It gets to be very expensive, and it's exceedingly common. If you're in that boat, you're not alone. Member engagement is another one. There's a little surprise here, at least for some of my clients. I don't have it on the slide, but there's a website out there called depositaccounts.com. And, we all know about social media, Facebook, LinkedIn, all these things where we may see online reviews and so on. And we want to demonstrate our local presence. But depositaccounts.com is basically a review of every bank and credit union in the whole country. And people can go out there and write reviews of a financial institution. And if you haven't looked at that for your own financial institution, you might be surprised. It gets more action than I would have initially thought. And it seems to me that people who are satisfied ignore it, and people who are angry, they will aggressively write poor reviews of a credit union. And so it's a good idea to go look at that if you haven't already done it. Member engagement, of course, from a local presence is important, as well. As we all know, we like to be involved in communities and so on. So economic uncertainty is our next challenge. And so I'm not going to give you the answer, but we'll ask the question, are we in a recession or are we heading into a recession, right? I don't know. but all of these news headlines that are shown on the screen, I collected over a span of a little over 2 weeks, right? And you can see that it's a mixed bag of things. You know, some of them are saying we're going to avoid recession. Some of them say that it's expected, but it'll be later than predicted. You know, some of them think that it's inevitable, right? And again, all reputable sources here, and a really wide mixed bag of opinions. So I'm not here to tell you which one of them is true, but the challenge is, of course, that we are facing uncertainty. We've got mixed messages, you know, everywhere we look. And so what does that mean for us to have mixed messages? It means that it makes budgets tougher. It makes, you know, rate setting tougher. It makes understanding our growth, our ability to grow tougher, right? Because there are so many unknowns coming down at us at the same time. So that's the end of challenges. Let's look next at marketing tools as we move forward. We like targeted campaigns in some ways, and some of this may be rehash and it may be common thinking, but I think it's widely held belief that, you know, younger members are more likely to visit social media. They're going to have a preference for mobile apps. They're going to want things to be easy and have us the ability to do everything on their phone, right? And I think that's really common. And seniors would be more likely to look at print ads in the local paper, direct mail campaigns that they physically get out of the mailbox, you know, things like that. So think about our members, think about the member growth that we want to see, right? If it's a new neighborhood with, you know, a senior citizen neighborhood, we're going to market different than if it's a new neighborhood and it's, you know, apartments and condos that are attracting a younger clientele. So think about targeted campaigns for those. Branding, I see as important. Pre-COVID, I used to visit probably 60 credit unions in person every single year, and I did it for a long, long time. And I saw plenty of examples where branding helped move the credit union growth in a positive direction, right? And it could be as simple as a new logo, as a color scheme. It could be as simple as, you know, a common shirts that people wear in the branches that all match the logo on the sign, and, you know, everything else we're doing. You know, branding can be very effective. It seems like it shouldn't matter, but I think it really does matter that we're giving a cohesive and professional message in every possible delivery point that we have. Oftentimes this requires the assistance of an outside professional. They come up with all kinds of, you know, ways to reflect, you know, what is important to us. Look at promotional offers next. Sometimes this comes in terms of promotional interest rates, sign-up bonuses, new money specials. These are all very common. I'm going to talk about sign-up bonuses. I've got a slide dedicated to that in a minute, so I won't cover it here. But the main point here is, you know, if you need funds, the quickest way to get it is to offer some sort of a CD special, right? And when I say this, I mean that members will come back to you, and I don't mean just any members. I mean the exact same members that you lost when you didn't need funds, right? If you need funds and you raise your rate high enough, those members will come back. They went somewhere and they're always shopping for the best deal, and they will come back. Now, I think we all know that if somebody's shopping for the best CD rate, or they want, you know, a little bonus if they bring you an account, these are typically not loyal customers to the credit union, right? The next time they find a better deal, they're going to run off and get that. What we recommend here on CD specials is to attempt a ramp up approach. So if you need funds, you know, offer a rate of some sort. If it doesn't, you know, bring in funds, you know, offer a little bit higher rate, and there is some level that will bring in members, and it really depends on how we engage with them and what else they're looking at. It doesn't have to be the highest rate in town. It has to be a rate that attracts people, and after all, nobody really knows what that rate is. So we like that ramped up approach. It might save a little money because the rate that brings people in could potentially be lower than what we think it is. We talk about cross-selling and bundling. The best part of this slide really is deepening relationships. And I think it's pretty common knowledge that if members are tied to us with things like online bill pay, their consumer loans, credit cards, direct deposit of their payroll or Social Security, if they're tied to us in a variety of ways, they are less likely to leave to get a better rate that's down the road, right? And so cross-selling and having people that have deep ties to the credit union, we think is very important. And it may end up, profitable in the long run because we have lots of products where they might pay fees or might pay interest. But also members that are engaged with us in this way are much less likely to move simply because interest rates are a little bit higher down the road. So we do like cross-selling and bundling products together. Referral programs are, an interesting thing. This is generally a bank exercise, and we don't see a lot of credit unions doing this, offering interest rate bonuses, cash rewards, that kind of thing. And so I've got a slide here. This took me maybe, 10 minutes to develop this slide. I just typed in some cities. You can do this in your own city. Type the name of your city and then the word checking account behind it, and you will get all kinds of offers. And if you ran around town, it's not this easy, but you could collect all kinds of money just by opening up all kinds of accounts. Now, nobody's going to give you, TD Bank in the lower right-hand corner is not going to give you $500 if you, open a checking and savings account, right? There's all kind of bells and whistles attached to most of these programs, and you need to do something, direct deposit, bill pay, and other things to get these incentives. You can't really just run around and collect up all this money. All these banks would go broke. Notice here that there's only one credit union on the list, and they're only offering $50, right? This, as I mentioned a moment ago, is traditionally a bank thing. I have been showing this slide for 5-7 years, and updated regularly. And very rarely do I find a credit union on this list that's offering this kind of incentive. Now, I've never quite figured out, is that because banks know more than we do, and so they offer these things because it's profitable for them? Or is it because, we know more than they do and that these programs are not of much value? I don't know what's true here, but I do know there have been studies on this, and that little orange box at the bottom, it's true that about 40% of people who open these accounts will actually fulfill all the requirements and get the incentive. So as an example, if we offered $100 for a new account and we opened up a whole bunch of new accounts, and 40% of those new accounts would meet the criteria, we'd pay them out the $100. So on average, right, considering the ones that we paid and the ones we didn't pay, we're going to pay on average for $100 incentive, we're going to end up paying about $40, right? And you can do the math. If you offer $200, it would be $80 on average, and so on. So very interesting strategy that we don't see often in the credit union world. If any of you have done that, I'd love to hear about it, what the success has been. Now let's talk about deposit pricing. We'll move into that direction. Our recommendation is always the same, and sometimes this recommendation doesn't sit well with some people, especially boards. We oftentimes hear that we ought to raise our deposit rates because our competitor did this, that, or the other thing, right? And our recommendation is always that we should be basing our deposit pricing mostly on our need for funds. If we don't need funds, we don't need to have a high rate. If we do need funds, we raise the rate. And, I've got however listed there. And that's because that relates to the next slide. When I hear people, sort of object to this idea that they need to keep their deposit rates low, right? Even though their competitors are raising rates, we do need to remain relevant. And this is one of the ways we remain relevant in our markets, is by offering a reasonable rate. It doesn't have to be the highest rate in town. It doesn't have to be the lowest rate in town, but we need to remain relative and at least competitive, right? There's no need to be the highest rate in town, which might result in us having more money than we could possibly know what to do with. I think every credit union does some review of local competition. If you're already doing that, it wouldn't be a bad idea to at least consider what's happening in money market mutual funds. It would be very easy to check that out online to see what, Schwab or Fidelity or one of those is offering for money market, overnight mutual funds and so on. We also suggest that we monitor deposit trends over time. After all, if deposits are moving internally from one account type to another, or if we're gaining or losing deposits, it's very interesting to review these trends in addition to reviewing the deposit rates that we've been offering. This last bullet point about regular communication with our frontline managers, tellers, and so on, I think is very important. I've seen many instances of this over the years where the tellers and management people are encouraged to share with senior management what their experiences have been. Even some of the smallest things, we notice that we're losing CDs to a certain competitor, or that people are complaining about our money market rate being too low. Those kinds of things, that's difficult information, but it's also key information. And if we can figure out a way to get that information to rise to the top, then it helps management make some better decisions. Now, this is not easy to do, but I think it's very important to do, the last bullet point. Let's talk about rate matching. So if in today's environment, if we absolutely need funds, rate matching is probably fine. But in different market environments, when we don't need funds as much, we ought to be able, as a management team, to turn it on and off, right? There's no reason to give a CD special if we don't need the funds. So I am generally not a fan of rate matching, but in today's competitive environment, it probably is necessary. A strategy, I was at a credit union last week, and I actually witnessed this happen while I was waiting for my appointment. This second bullet point, they had an unadvertised short-term CD special that was available only to people who inquired about money market rates. So if the money market rate was paying 50 basis points and people said, hey, I'm really not happy with that, are you planning to raise your money market rate? Well, raising the money market rate, if you do that, you're going to have to do it for everybody. And you've got one member standing in front of you that's complaining about it. So this credit union had a CD special that was sort of in their pocket and available. I think it was a 3-month special, or you could choose 3 or 4 months. And they'll offer that for people who are, concerned about money market rates. Now, it wasn't the highest rate in town, but it did serve to retain some funds and help to limit the overall cost of funds, because again, it would be very, very expensive to raise the money market rate for every member. Let's talk about fee waivers. It is becoming much more common to talk about fee waivers. And the one that really is getting the most attention is this overdraft fee. And there was an Overdraft Protection Act of 2021. And this was an effort to limit or even eliminate overdraft fees. But the person who introduced this bill lost her reelection bid, and it was not carried forward and has not been enacted yet. Now, I would suggest that we pay a little bit of attention to that. Some of our clients, even against our recommendation, have eliminated those fees because they thought that the law was going to change and they were going to have to do it anyways, right? So we would recommend two things, the last two bullet points: review what your competitors are doing. And, this is probably as easy as going on their website and looking at their fee structure, right? Comparing it to what we're doing. We, at the moment, recommend not changing fees unless the regulation requires it. And that's, of course, if your competitors are all, waiving fees, we might want to, consider that. But we don't see any real immediate need to change that until, the regulation changes. Now, fee waivers in general, away from overdraft fees, it seems to me, just in my experience, that people don't generally move, from one institution to another based on a individual fee. More likely, they are going to choose an institution because the balance that they plan to maintain on deposit will offer them a free account. Right. I think that sort of a fee discussion or review is more important than an individual fee for overdrafts or, any other service. Right. Look at those balances required to maintain a free relationship. So let's talk about tier strategies. This is another one of those things that we didn't have to think about for probably 10 years because, the difference between, the low balances and high balances was, 10 basis points top to bottom. Now we've got fee structures that look like this. This is actually from one of our clients that I lifted off of their website, and they have an interesting fee structure. They'll give you 1% for very small balances. And I think this is to attract, new money deposits. And once you get over that $500, right, you don't earn 1% on the first 500 anymore. If you had $600 in there, you'd earn 1 basis point on the whole 600. So to me, there are too many tiers in a structure like this, and there's not a great deal of incentive to bring additional funds to the credit union, right? So I'm not in favor of this particular fee structure, and I think there are better ways to structure and look at tiers. Just too confusing here. Here's a strategy that I think makes more sense. And this is a real life example where I was working with a client to try to bring some funds in, and we sort of tinkered with their tiers, right? On the left-hand side, you can see before they had a 25,000 to just under 50,000 earned 25 basis points, and then 50,000 to just under 100,000 was 40 basis points. We eliminated one tier, which made it simpler, easier to understand, and we upped the rate to 40 basis points. And the impact of this is now, so you see there's a difference of, up to 25,000, you earn 10 basis points. Over that, you earn 40 basis points. There's a big jump there compared to the old fee structure. And what will happen here invariably is people that are in that segment of 10,000 to just under 25,000 will bring more money to the credit union to earn the higher rate, right? And it didn't cost us a heck of a lot of money. We didn't raise the rate for everybody, right? We raised the rate for a segment of people who we think might bring us some more money. It's because there's a greater incentive for them to do that. There's a pretty big difference between the tiers, and the tiers are sufficiently wide enough that it entices people to bring more funds to us to get into that tier. We like tier structures that look more like the one on the right. So now let's look at borrowing options. Like it or not, many of us are going to have to borrow at some point, right? Investment portfolios underwater, or loan demand far outpacing deposit, growth, and so on. The Federal Home Loan Bank issues all kinds of innovative structures. This is not like you issuing CDs, right? If you issue CDs, they have a term on them, right? They last 2 years, and you earn interest, and that's about as complex as it gets. If you go to the Federal Home Loan Bank's website, most home loan banks have their fee structure, excuse me, their yield structure and programs listed right for you to see whenever you want to see it. And you might see 20 different programs, right? And in some cases, it's very hard to determine what you're looking at. So I would just give a word of caution here. Sometimes a yield is going to look very attractive. You might see a yield that's lower than others, but it gives the federal home loan the option to call the bond away or call the financing away from you. This is called a puttable advance, and it's called puttable because they have the option, right? So let's say, you know, the yield on a standard advance was 5%. They might offer you 4%, but it would give them the option to call it away from you and force you to borrow again, right? If interest rates went up, they are going to call that away from you early, right? And it won't last the original 5 years. It might only last 3 months or a year or something like that. And they will call it away because interest rates went higher. It will force you to rewrite and reborrow for a new term at a higher rate. The Federal Home Loan Bank has way more information than we do about markets and, you know, swaps and all sorts of information like that. And they will pull these away from you when it is in least likely to be in your favor and most likely in their favor. So if you are in a borrowing position, we like just plain vanilla fixed rate, what we call bullet borrowings. And some of them have different names for them, but all the bells and whistles in the world may look attractive, but they do have their challenges. And you should, if you're considering those kind of options, you should very carefully look at what you're about to do, because we have seen many instances of people being surprised when interest rates move and they don't have what they thought they had. Now let's look at liquidity and interest rate risk management. This is really talking about, you know, tools that we might deploy within our process in the ALM model or in liquidity testing that we do, because a well thought out deposit strategy really relates very closely to, you know, our interest rate risk. We obviously want to meet customer demands, respond to unexpected events, endure economic downturns, and a well thought out strategy allows us to do that. But the way we measure it is through the asset liability management model. Now, we suggest that you run lots and lots of simulations within your model. We know that rates on non-maturity deposits especially, but on term deposits as well, when the Fed raises rates, we don't move in lockstep, right? We might move 25 or 50 basis points or something. Your ALM provider can probably do what's called a core deposit study to measure, you know, your past history and how you move rates in relation to the federal funds rate changes, and they can incorporate those assumptions into the model. These deposits provide incredible value to you, right? And we ought to be able to measure that in the ALM report. We suggest that you run, if your model is capable of doing it, we suggest that you run for your own benefit, for benefit of the board, and examiners will also love it. We suggest that you run lots and lots of simulations through your ALM model. Our own ALM model has online capabilities where you could run a simulation in less than a minute. And we suggest to our clients lots of simulations, and they might be, you know, the impact of having to borrow, right, in 6 months from now, if we think that loan demand is going to continue and deposits, you know, deposit goals can't be achieved. So we could measure the impact of that. Or the one that examiners are often asking for, which you might want to run in advance of an exam, is, you know, what would we look like if, you know, a huge portion of our non-maturity deposits or money market funds moved into a CD special, right? Those kinds of things can be measured in the ALM report, and many other things. You can measure the impact of having to quickly raise your rates, right, which might happen and might not be measured in the original run of the ALM model. So there's many, many things you could think of. And we think from a risk management standpoint that you should be measuring all kinds of things like that. We also know that liquidity has been top of mind with examiners for many, many months now. When Silicon Valley Bank collapsed, one of the biggest banks in the whole country, when they collapsed, it got examiners talking about liquidity risk at the smallest credit unions in the country, right? The two institutions have literally nothing in common, but we found that examiners are hitting home on liquidity more than they ever have, right? And so just as a little precaution is it's a good idea for us to be thinking about those things as well. And we can do that by running additional liquidity reports or what if scenarios through the ALM model. Just a good practice to be doing more of that than maybe we ever have, and to brush off your liquidity policy, contingency liquidity policy in advance of examiners showing up, so that we understand what we're supposed to be doing by policy and to make sure that we're actually doing it. So that is it for the presentation. I would welcome you to reach out to us. If you have any questions about this, we would be pleased to chat with you.